TradeFXDirect.com presents How the Money Market Hedge Works. The money market hedge is a viable option for retail traders to hedge currency risk. This is because the money market hedge has a lot of avenues, such as options, futures, and currency forwards, to hedge foreign exchange risk. This same reason makes it an unsuitable option for institutions and large corporations. Before we can describe how the money market hedge works, it's important that we describe what it is. This is a technique when you use the money market to hedge foreign exchange risk, the financial market. This exchange is characterized by short-term instruments such as commercial paper, bankers' acceptances, and the treasury bills are used. In order to understand how the money market hedge works, it's important to understand foreign exchange risk. Foreign exchange risk arises either as a transaction exposure or translation exposure. Transaction exposure arises due to payments that are due in foreign currency. On the other hand, translation exposure arises when assets and liabilities are denominated in a foreign currency. The money market hedge is optimal for hedging transaction exposure when the foreign currency is expected at a later date. When using the money market hedge, there are several ways to mitigate a situation where the currency receivable is due at a later date and time. First of all, you can borrow the foreign currency in the amount of the receivable, or you could convert the foreign currency into the domestic currency at the spot rate. You can then repay the loan you borrowed when the receivable comes in. The application. This technique is effective for currencies where the forward contracts are not readily available. Therefore, it's ideal for currencies that are not widely traded. It's also perfect for small businesses that don't have the wide-reaching access that larger corporations would have on the forex market. But perhaps its most beneficial application is for minimal amounts and where a person wants a currency hedge but doesn't want to use currency options or futures. As an alternative to mitigating currency risk, the money market hedge is certainly effective. It is, however, not suitable for large corporations and institutions. It may seem complicated to the average investor, but it is highly effective as a risk assessment strategy. It also carries another advantage of being easy to set up for most people. It does, however, require that the investor have bank accounts denominated in different currencies. There are disadvantages, though, chief among them being the effectiveness of the hedging technique. It is susceptible to a number of logistical constraints. The actual interest rates may be very different from the institutional rates, which make the money market hedge unsuitable for single transactions. It is best used for continued transactions. In essence, it's a technique that you can use if you deal with small amounts for goods that are traded in a foreign currency. Do you trade in foreign currency, and is this technique something you would consider using? Let us know in the comments section below. You were listening to a TradeFXDirect.com production. 100% sharing bonus and 40% power bonus. Unparalleled trading. Join today at TradeFXDirect.com.